the PE ratio, the price to earnings ratio. The price to earnings ratio pretty much tells you how much price are you willing to pay for the earnings, also the net income of the company. At this moment, Coca-Cola is selling close to $50 and it has earnings a little over $2. It's actually at $2.12. So if I take the PE ratio, the price divided by the earnings, the PE ratio right now is 23.33. So if I bought Coke, I'm pretty much saying that I'm willing to pay 23 times the earnings of Coke. Now, what's a good PE ratio then? Now, there are no hard and fast rules. Every investor has their own guidelines when it comes to the PE ratio. Plus, you also have to look at the particular industry that you want to invest in. On average, I like to see a PE ratio of 20 or less, or even 15 or less. That's even better. The PE ratio also gives you a quick snapshot on how long it would take for you to get your invested capital back in the form of earnings. Now, that's just a quick snapshot because, of course, you know, the market is always moving, the price is always changing, earnings and net income on a yearly basis also changes, but it gives you a quick snapshot of, okay, if the PE ratio is 50, it would in essence take you 50 years to get your money back. Now, there are some companies that have extremely high PE ratios, especially growth stocks. So for example, Tesla has a PE ratio over 1,000. That pretty much means, looking at the snapshot, that it would take over 1,000 years to get your invested capital back. People don't even live that long. But like I said, the stock market is dynamic. It's always moving. It's always changing. So the earnings of a company, especially when you look at the growth companies usually focus on taking any income that they generate and they put it back into the business in order to expand the business as fast as possible.